Hello everyone, welcome to the very first video on Trade on TV's channel about market analysis. Today we will talk about a lot of different topics. In the very beginning, I'll talk to you about the core basics of market analysis, which are very important in order for you to follow me, especially in this analysis. And we will talk about topics like the efficient market hypothesis and some fundamental, technical, and psychological analysis methods. And after that, we will jump to the next topics. We will start with the liquidity and the macro perspective. We'll talk a little bit about politics, especially geopolitics, which are influencing the markets currently, specifically. And after that, we will talk about the most important topic for me, which is the DXY. And the reason for that is that the US dollar is the world reserve currency. And in order to actually understand the markets, we have to understand the US dollar and how it works. And after that, we will talk about cryptocurrencies, we will talk about commodities such as gold and silver, and we will talk about some stocks and indices as well. And at the end, I will give you an outlook on the markets for 2026, or let's say for the next few weeks. In the last few weeks, we had so much volatility. It was actually quite incredible. We had the Bitcoin swinging aggressively, we had the gold gaining strength and then losing that strength again. We have the dollar reacting sharply in this matter as well. So what is actually happening beneath the surface? And we will answer these questions. But before we start with that, we have to understand the core basic market analysis. So every investor has a different way of analyzing the markets, and you have to decide this for yourself as well. I will give you a short introduction into these different methods, but you have to choose on your own the best that works for you. So basically there are many different methodologies, and I will tell you the most important ones, which are the fundamental analysis, the technical analysis, and the psychological analysis. And when we start with the fundamental analysis, it basically makes sense because it's named after the fundamentals of an analysis in general. And the fundamentals in stocks, for example, are the core information about the company or the stock itself. For example, what does the company do? Let's use NVIDIA as an example. NVIDIA is producing microchips, and it is one of the biggest companies in that matter and generally. And on top, you have the analysis about the market cap. For example, how much is the value of every stock on the market? Then you have the earnings per share and some other indicators. Then you have some opinions by some investment banks if you should buy or sell the stocks. So all of these information that you can collect in a very short time are basically fundamental analysis. They build the fundamental to your analysis. And in these methodologies that I explained, which are fundamental, technical, and psychological, you don't have to choose one. Basically, it's a combination of all these three in order to have a great analysis about the markets, because you will understand the reason for that after I explain the other parts as well. So the technical analysis is the analysis of the charts of these commodities, stocks, cryptocurrencies. So basically you have the information, which are the fundamentals, and after that you have the information about the development of the price in and of itself over the last few weeks and months. And for that, you can use some applications on your mobile devices. And in the last video, I explained to you that we will be releasing our mobile phone application. And then you will have something like this. I hope you can see it right now. And I will also show you some screenshots and some analysis about it. But basically what I wanted to show you is this. Now you can see it. You have the charts, you have the candlesticks, you have the the red and green candlesticks, which basically mean that the price is going up or down. And on top, you have some indicators of your own choice. There are, for example, volumes. There is the RSI, there is the MACD. There are many different indicators which basically show you the information that are already on this chart in a different way. And these additional information help you in order to analyze and decide if you should invest, buy or sell, have a long position or a short position, and that's basically up to you. But this is the technical part, and on top there is the psychological part, because we always have to take into account that we as traders or investors or people of the financial markets trade with and against other people. So there are human beings. Obviously, there are also AIs and supercomputers that are trading as well, but these are somehow programmed by human beings as well. So basically, there are the psychological parts always inside of these methodologies. So what we have to take in account in psychological analysis is that we as human beings, we have emotions. And these emotions are affecting our decision making. And this you have to take into account as well. And after you have these three methodologies and three major topics you have to take into consideration in your analysis, you can form an overall analysis. That's basically how you can do it. And after you decide on how you do it, you will be able to make at least a strategic analysis. You have a strategy in order to make your analysis and your decision making. Now let me explain you how markets generally work. So what you have to understand in the markets, there is the efficiency market hypothesis, which basically means that every information about a company, a stock, about a cryptocurrency, about a commodity is already shown in the price in and of itself. So there's no surprise. If there is known that Apple has a great quarter, for example, this year, and somebody knows it, and this gets talked about, then the price will increase in that matter, and it will be automatically shown in the price on the charts. So this is the efficiency market hypothesis. So we believe in this methodology that the markets are efficient and any information is already shown in the price and the chart. So basically, if there is bad news, it will show you in the chart, and if there is good news, it will be shown as well. So basically, all publicly available information are reflected in the price. Obviously, there are some information that are not available for the public, but these are some exceptions, and this is not important enough right now to discuss about, but this is obviously something you have to keep in mind as well. On top, markets are forward-looking because we as human beings, we invest in, for example, stocks with a specific intention, which is that the price will go up. And if you open a short position, for example, you expect that the price will go down. So we are investing not for this second, but for the next week, or for the next month, or for the next year even. So it basically depends on your investing or trading strategy as well, but it is always about the upcoming, it is always about the future, it is always about the events that can happen in the future. And on top, what you also have to keep in mind is that in most of the potential values that you can trade, there is always a buyer and a seller. So basically, if I want to buy a stock right now, there has to be someone who sells this stock. It actually makes sense, but you have to keep that in mind because a lot of people don't do that actually. And if you take this into account as well, this basically means that if I buy a stock right now and you sell it right now, we both believe that we are right, because if the price would go up and you would expect that as well, you wouldn't sell me this stock. And you believe that this stock will go down and I believe that the stock will go up. So basically, there is always a fool, or there's always one part of this transaction that is doing something wrong, but they don't know that in that moment though. So that's also something very important. And in the financial markets generally, there is no value creation in a specific way. There is only the redistribution of money, or basically wealth. And that makes sense because, as I explained in that example with the stocks, buying and selling, one of us will make money in that transaction and in these events, and one of you won't. So it basically means there's redistribution of money, but no new created money. So now we talked about how the markets work and the core methodologies that I explained to you. And we can actually talk about these topics for hours, but I want to make it as understandable and convenient as possible for you. So if you have any questions, you can always ask in the comments. Now we will talk about the macro and liquidity, because we obviously have the fundamental analysis, basically the fundamentals of that, let's say, stock. And then we have the technical analysis, which basically means the charts and the information that are represented and reflected in the prices. Then we have the psychological matters as well. And all of these are influenced by the macro and especially by the liquidities. Because when we see these topics in a macro perspective, and macro perspective basically means that how, for example, the economy of a specific country or a specific zone or of a whole continent or the whole planet even is currently working. And there you have, for example, interest rates, you have inflation expectations, you have bond yields, you have global liquidity, you have shortages, you have specific parts that are very important for your decision making on the markets. Let's say there is a crisis, for example, that in a specific country there is no possibility anymore for, let's say, 3 months to produce specific products. This will affect the company that sells it, right? So automatically this reflects in the prices as well. It will obviously mean that the markets will go down first, and after that, if there are any decisions made about the company's future, then it may go up again. But basically, the markets are influenced by these macro topics as well. And for that, you have the economic calendar, which is very important for many investors who are specifically trading in a short term. And in this economic calendar, you have every day so many different news released by companies, for example, the earnings they have in the specific quarters or in a year. Then you have the authorities of specific countries or zones, for example, the European Union, which are releasing interest information, they are releasing inflation expectations and the actual inflation, they are releasing the unemployment rates, and these information are very important, especially on a macro level, and are influencing you in your decision making and the charts as well. Now let's get technical with the DXY. So a short introduction about the DXY. The DXY is showing the strength of the US dollar. And why is that important? The US dollar is the world's reserve currency. It's the most important currency, and especially, for example, US American stocks, gold, commodities such as silver, oil, all of these are traded with US dollar. So this is very important because if the US dollar is very strong, automatically the prices could go down of these commodities, let's say. And if the US dollar strength is decreasing, then these commodities, let's say, can go up in value as well. And if we check DXY on the markets right now, you can see that in the last 4 weeks, the DXY lost a lot of value. It lost basically up to 5% in value. On top, when we check the markets a little bit more broad, we have the performance of 1 year, which is basically minus 10%. So we can see a development of the US dollar, which is going down. This is automatically reflecting the commodity prices as well. We will talk about gold and silver as well. And on top, these are influenced by specific macro events as well. We have seen that there are wars on this planet right now. We have seen that America has some geopolitical problems, for example, with Venezuela. And we have many different topics that are influencing the US dollar as well. We have the interest rates that are decreasing. We have the unemployment rates, which are also influencing the DXY. And basically, if you do an analysis about markets that are traded by US dollar, which basically are most of them, you should check the current development of the US dollar currency as well. If you are a trader or an investor which is trading in euro, there is basically the same, which is the euro currency index, where you can check the strength of the euro as well. And now when we check the euro to US dollar, we can see that in the last few weeks and months that the US dollar has lost a lot of value. And when we check the markets right now, we can see that euro has gained a lot of value, up to 15% from last year's performance up until now, and that is a huge number. And we can see the analysis we did before. We can see that the US dollar has lost a lot of value because of different reasons, and this is reflected by the euro prices as well. However, it is very important to distinguish if the only reason the price of the euro is going up is the weakness of the US dollar, or if the euro actually is performing well as well. And when we check the performance of the euro and the strength of it, we can see that the euro is gaining value generally. Now let's check some commodity prices, and I am checking the gold prices right now, and we can see, and everybody knows, that the gold prices and the silver prices are extremely high right now, especially the development over the last few weeks, because in the last 3 months we have gained 20% in value, and in the last 6 months even 50%. And that's only about gold, because silver has even gained more in value. And the reasons are quite different. There is the reason of the macro events that happened. All the wars, all the potential wars that are upcoming are raising fears in the markets, and then people tend to invest in commodities that are safe. And for example, currencies are not seen as safe, especially not in wars, because currencies can basically be printed, but commodities are limited. That's why people tend to invest, especially in hard times, into commodities such as silver and gold. And that's what we have seen in the last few weeks as well, that people are investing in these commodities. And the development shows us as well that the prices can go down extremely fast as well. We have seen that in one day, the silver prices lost up to 10% of its value, even more, even 20, 25, 30%. And these kind of events happened with cryptocurrencies that we know of, but silver prices dropping that fast did not happen that often. So you have to be careful with your portfolios and investing strategies as well. Now, when we talk about cryptocurrencies, we obviously have to check about Bitcoin. And when we check Bitcoin, we can also see a decreasing Bitcoin price. In the last few weeks, we have lost up to 40% of the actual value in the last 6 months. And we can see that the Bitcoin prices have seen prices down to 60,000. We have seen prices up to 110, 120,000. So cryptocurrencies are also very volatile. The reasons, as I already said, are different. Bitcoin is traded against the US dollar, so you have to check the US dollar performance. However, the US dollar is actually quite decreasing. So actually, if the Bitcoin is not losing value in and of itself, it should go up, but it is not. And there are different reasons in the crypto world as well. For example, there is this theory that the Bitcoin price has to go down every 4 years because of specific reasons. But I don't want to talk about the analysis of these different parts, commodities, cryptocurrencies, in a deep level. We will do that, and we can do that if you want to. And then we can only analyze the Bitcoin price, or we can only analyze some currencies. However, it is always to be said that any analysis and any opinion I give is only my perspective. It is no consulting of any kind. I don't give you an advice to do something. You always have to check, and you always have to analyze and make your decisions on your own way. And when we check the cryptocurrencies, we can see that the prices are going down, obviously, and because of all the potential risks of the future, the potential upcoming wars, we don't know right now how the markets will be fundamentally reacting to all of these events. However, you can do a technical analysis of these parts, and you can check some volatility zones, which are price zones where there's a lot of volatility, and markets are tending to trade towards volatility zones. You can imagine that in that way. But I will do a video about volatility and the meaning and the especially importance of it when you think about institutional investors and traders and hedge funds. But we will talk about all of these topics in another video. What I want to tell you is that basically what to expect in 2026. We can never give a forecast because you always have events that are happening randomly and that can influence the markets. For example, just the COVID in 2020 and all the markets went down. However, when you talk about the global economy, and I'm not talking about specific, let's say, cryptocurrencies or whatever, I'm talking about the global economy, we can see a development that is always going up. So the macro development of the global economy, and meaning the stocks and commodities, were always going up in value. And you can check the prices of stocks, of the S&P 500, of the Dow Jones, of any kind of information, and you can always see it is going up. So in hard times, you obviously have a lot of potential risks of losing money. You always have to keep in mind that you should be hedging your portfolios and you should diversify it. However, in times of uncertainty, we should see these times of potential opportunities and not of times of where we don't do anything. What I can tell you is you should do an analysis, you should follow the markets, and as soon as you do your own analysis and you see yourself an opportunity, you can invest into these markets. In the following videos, we will talk about specific topics that I mentioned in this video. We will talk about technical analysis and fundamental analysis and how you can actually do it. And after that, we will check the developments on a weekly basis or on a monthly basis, depending on the current events. And now let me do my final statement. Let me tell you the following. Markets are not random. They move based on incentives, liquidity, and expectations. And if you understand those three forces, volatility becomes analytical and not emotional. And uncertain times create disciplined investors. And let's hope that we have great times ahead.